Hey everyone, welcome back to Corporate Decoder, the place where we break down these dense financial reports so you don't have to. And let me tell you, we've got a gem today, MFS Growth Fund semi-annual shareholder report. Looks like they're keeping things growing, but at what cost? After all, even growth needs a little checking under the hood. So make sure you subscribe because we're about to dissect this report and see what's really going on. Oh, and before we really dive in, if you're looking to connect with fellow finance enthusiasts and get these insights delivered straight to you, we have a fantastic Discord community linked in the description. You won't want to miss it. This report is from MFS Series Trust 2, covering the MFS Growth Fund. It's a look at how the fund performed for the 6 months ending May 31st, 2025. Think of it as a mid-year checkup on their investment strategy. The first thing that jumps out is the sheer size of this fund. We're talking about nearly $45 billion in net assets. That's a massive amount of money being managed and invested. When you manage that kind of capital, every small percentage point move can mean millions of dollars. They hold 73 different investments. This is a pretty concentrated portfolio. Holding fewer assets can mean a more focused strategy, but it also means that if one or two of those holdings perform poorly, it can have a bigger impact on the overall fund. The overwhelming majority of the fund, 99.1%, is in equities, meaning stocks. This tells us where they believe the growth is and also where the risk lies. Looking at the breakdown of those stocks by industry, information technology is the biggest slice of the pie at 37.6%. That's a huge bet on tech companies. Communication services is next at 17.4%, followed by financials at 11.7%. This sector concentration shows us where the fund managers are seeing the most potential for growth right now. They're really leaning into technology and businesses that connect people. Now let's talk about the big names. Microsoft is their top holding, making up 12.4% of the portfolio. That's a significant chunk of money tied up in one company. Nvidia is second at 8.1%, followed by Amazon.com at 7.6%. When you see these tech giants dominating the top holdings, you know the fund is really betting on their continued success. It's a strong vote of confidence in these established tech leaders. The report also details different share classes and each has its own cost. For example, Class A shares have costs of 0.84% of your investment. So if you invested $10,000, you would have paid about $42 in costs over the last 6 months. Class A shares are cheaper with costs around 0.59% for that same $10,000 investment. That difference might seem small, but over a long period, especially with massive amounts of money, those fees really add up. It just goes to show that fees are a critical factor in fund performance. And then you have Class R6 shares at just 0.49%. While these fees are lower, they typically come with different access or purchase requirements, often for retirement plans. It's important for investors to pick the class that best suits their situation. Diving into the actual holdings, we see a lot of familiar names. There's General Electric Co. in aerospace and defense, LVMH, Moet Hennessy, Louis Vuitton C in apparel. Netflix is there with over 1 million shares, valued at more than $1.3 billion. Alphabet, the parent company of Google, also shows up with over 12 million shares worth more than $2.1 billion. And Meta Platforms, that's Facebook and Instagram, they have nearly 4.8 million shares valued at over $3.1 billion. These are massive companies, and the fund is definitely riding the wave of their performance. Looking at the statement of assets and liabilities, their total assets are over $45 billion. This just reiterates the scale of operations we're dealing with here. The net asset value per share varies across the different classes, with Class R6 shares having the highest net asset value per share at $204.50. This difference in NAV per share reflects the different fees and expenses associated with each class. The statement of operations shows the fund's income and expenses for the 6 months. They earned over $125 million in investment income. However, total expenses came in at almost $145 million. This means that for this 6-month period, the fund spent more on expenses than it earned in investment income. This resulted in a net investment loss of over $15 million for the period. On the flip side, they had a strong showing in realized gains. They reported a net realized gain of over $1.6 billion. That's a substantial gain from selling some of their investments. But the market fluctuates, and they also saw a net unrealized loss of nearly $1.85 billion. This is the change in value of the investments they still hold. When you combine everything, the total change in net assets for the fund was a decrease of over $3 billion during this 6-month period. This is a significant drop and something investors would want to pay close attention to. The financial highlights table provides a longer-term view, showing net asset value and total return over several years for each class. It's always good to see how the fund has performed over time, not just in a single reporting period. For Class A shares, the total return for this 6-month period was a negative 0.34%. This means an investment would have lost a small amount of value. Class A shares had a slightly better return, a negative 0.22%, and Class R6 shares were the best performer among these with a negative 0.17% return. While all classes show a slight loss for this period, the differences in these returns, even if small, are directly related to the varying expense ratios we talked about earlier. For Class A, the net investment income per share was negative 25 cents. This shows that the income generated from the fund's investments wasn't enough to cover its expenses on a per share basis. The portfolio turnover rate is 14%. This means that about 14% of the fund's holdings were bought or sold during the period. A lower turnover rate generally suggests a more buy and hold strategy, which can sometimes lead to lower trading costs. Digging into the notes, the portfolio of investments is where they list every single security. The total value of investments in unaffiliated issuers, meaning companies not related to MFS, is over $44.6 billion, with an identified cost of over $19 billion. They also have about $386 million invested in the MFS institutional money market portfolio, which is an affiliated issuer. This is basically a place to park cash that's managed by MFS as well. All these numbers lead to the final net assets figure of $44.9 billion, matching what we saw earlier, which is good for consistency. The fund's management seems to be closely monitoring performance, using key metrics to guide their decisions. MFS has agreed to reduce its management fee by over $3 million for this period. This is essentially them giving back some of their fees to help improve the fund's performance, which is a positive sign for investors. They also mention voluntary rebates on service fees for certain accounts. This means that if you invest directly and not through a broker, you might get a small break on fees. It's a small detail, but shows they're trying to be competitive. There are also contingent deferred sales charges, or CDSCs, mentioned for Class AB, and it's about $31,933 in these charges collected over the period. These are fees you might pay if you sell your shares too soon. The report also details transactions with affiliated parties, including purchases and redemptions of fund shares by MFS itself. These are just internal movements of money. They had a redemption in kind, meaning a shareholder cashed out by taking some of the fund's actual stocks instead of just cash. This generated a realized gain of over $26 million for the fund. Now, stepping back and looking at the overall picture, MFS Growth Fund is a giant in the investment world, managing an enormous amount of money. Their strategy heavily favors growth stocks, particularly in the technology sector, with major holdings in giants like Microsoft, Nvidia, and Amazon. The fund's performance for this 6-month period was a bit of a mixed bag. While they achieved significant realized gains from selling investments, the value of their remaining holdings decreased, resulting in a net loss for the period and a decline in overall net assets. The fact that expenses slightly outweighed investment income before considering capital gains is also something to monitor. However, MFS is showing some effort to offset costs through fee waivers and rebates, which is a good sign for investor confidence. The biggest strengths here are the strong portfolio of top-tier technology companies and the sheer scale of assets under management, which can lead to economies of scale. The weaknesses are the negative short-term total return and the slightly higher than optimal expense ratios for some share classes. For investors, the key takeaway is that while the fund is heavily invested in high-growth areas, the recent period showed some market volatility impacting unrealized gains. It's crucial for investors to understand which share class they own and its associated fees, as these can significantly affect long-term returns. The fund's direction seems set on continued growth-oriented investing, but they'll need the market to cooperate to turn those unrealized losses back into gains. Alright, that's our deep dive into the MFS Growth Fund's semi-annual report. What are your thoughts on their heavy tech bet and the recent performance? Let us know in the comments below. If you found this breakdown helpful, give this video a thumbs up and subscribe to Corporate Decoder for more insights from the world of finance. And hey, don't forget to join our Discord community. The link is in the description. Thanks for watching, and we'll see you in the next one.